Hey everyone, Nick Nielsen, Certified Financial Planner. Today I want to take a few minutes and walk you through the process that we take the families that we guide through to determine how much we actually need in cash, fixed income, and investing for growth. We call the process 654, or the 654 of asset allocation. And so before we begin, there's a couple of data points that we're just going to put on the paper here to make it a little bit simpler to understand the process that we're taking people through. So the first three data points that we're looking for are our monthly expenses, the monthly portfolio income, and then finally, our investable assets. And for our example today, we're just going to make up some fictitious numbers so you can follow through the exact process that we would take the families through. So let's say that our monthly expenses are $10,000 a month, and of that we need to get $6,000 from our portfolio, and it's $1 million portfolio. So with that as a backdrop, we're going to actually get into the 654 of the process. All right, so 6 stands for 6 months of emergency funds. So once again, our monthly expenses are $10,000 per month. So our emergency fund is going to be $60,000. All right, the 5 stands for 5 years worth of portfolio income. We want it to be in fixed income. So so here we have our fixed income, and that calculation is going to be $6,000 per month times 60 months, and that is going to bring us to $360,000. And of those dollars, we would allocate that. We like to ladder bonds. So we think about what a bond ladder is right now we would have, let's say, $120,000 in a 2024 laddered portfolio, $120,000 in a 2025 laddered portfolio, and then $120,000 in a 2026 laddered portfolio. We'll get more into that in a minute. And then lastly, 4 is we invest the rest or the balance for growth. And so you'll notice that this process, it doesn't have any rules of thumb. There is no magic percentage based upon your age. We are working with real data like your monthly expenses, how much income you need from your portfolio, and the actual investment amounts that you have on hand. So in this case here, we started with $1 million. That was the investable amount that we had. $60,000 gets allocated to the emergency funds. $360,000 gets allocated to fixed income, so that leaves us with $580,000. That is what we would invest for growth. So I think if you're playing along at home, you're thinking, well, why do you build the portfolio that way? We think that there are 3 main reasons why we build the portfolio the way that we do. Number 1, the stock market on average gives us a positive annual return about 70% of the time in a given year. However, you'll notice that that percentage, while it is very nice, it's not 100%. So we know that the stock market tends to do this over time. Now, historically, over a long period of time, history as our guide, the stock market kind of goes up and to the right. We'll see if compliance lets us keep this picture in the video. Obviously, past performance is not indicative of future results. Returns are not guaranteed, all of the great disclosures. But the key that we build the portfolio the way that we do is because we think one of the most important parts of investing is we have to have a plan in place not to sell when the market goes down. We do not want to sell here. Never sell into weakness. The second point is we believe that there is a substantial cost of admission to be a long-term growth investor. And in this hypothetical situation, we're talking about someone who would have a 58% allocation to growth. So number one, we believe that when we invest in companies, the stock market, that every year historically there has been approximately a 15% drawdown. That doesn't mean that you lose money, right? The market could go up 30 before it drops 15 to still be positive 15%, but from peak to trough, there's about a 15% gap every single year that happens. Now the second one is the one that really makes people a little nervous, is approximately every 5 years, there is a 30% or greater drop. You have to believe that in those two things, you have to know it and be able to react accordingly when they happen to be able to get the long-term return of the market. We're talking about the S&P 500 here, which is just a nice proxy for large, well-capitalized US-based companies. So the S&P 500 has historically returned over the past 100 years or so approximately 10%. So we want as much money invested for growth as possible because we believe that the market will go up and to the right over a long period of time. While it's not guaranteed, we know that there will be volatility along the way, and we have to have a plan to deal for that. And that's why we have fixed income and emergency funds. That is our break glass in case of emergency money. Now we talk about this 10% rate of return, and if you go back to 1926, there are actually only 4 different years that the returns in the stock market have been between 7 and 10%. So the returns of the stock market are really, really lumpy. A lot of times when it's good, returns are 20% or more, but 30% of the time the returns are negative. We might average 7 to 10%. However, there's a good chance you may never actually see 7 to 10% credited to your account in any year in which you invest. Third, and finally, we think it is critically important for our fixed income money to be more stable. We do not want to take a lot of risk with this portion of our money. So there's a lot of different fixed income assets that some people might be interested in investing in. We want to stick with investment grade corporate bonds for the most part. We are a huge believer in laddering our fixed income portfolio. So what is a ladder? What does it look like? So with a fixed income ladder, we want to have different investments that have a defined maturity. So we might have some bonds that mature in 2024. What we would do then, as these bonds mature or approach maturity, we would roll these bonds to the next rung on the ladder, 2025. As we get closer and closer to the end of 25, we would then move those to the next rung on the ladder, 2026. So we want to continue to roll that money in to the next rung on the ladder. The reason why we do this is really important. This is going to minimize those swings in interest rates because especially bonds, the price of bonds is directly impacted by the current interest rate environment. So if interest rates go up, the value of bonds go down. So we want to ladder our bonds to sort of minimize or hedge those interest rate risk movements. Another thing that's really nice is that we have a yield to maturity. When we start to put a portfolio in place, we will be given a yield to worst. Now, there could always be different things that affect that yield to worst, such as bonds not paying their interest payments, companies going into foreclosure. But if everything goes as planned, we have a yield to worst, which gives us a number that we can shoot for that you can't generally get in an open-end mutual fund. And another incredibly important fact is we have some built-in liquidity because we always have money coming due, because we might need some of those dollars being available and liquid to us if we have a down year in the stock market, because we believe that the sole purpose of fixed income is really not a component of total return, but we want to have something that we can go to that is safe, liquid, and available when our growth investments have depreciated in value. So that's the process that we take all the families through, that we guide when we build their portfolio. This is a starting point of how we start to move around different dollars and investments to decide how much we want in cash, how much we want in fixed income, and how much we can invest for growth. I hope you found this video helpful and learned a little bit more about our process and the reason why we build the portfolios the way that we do. Thank you so much.